Well, the dollar was probably going to go above parity anyway, since there's been a new air of optimism around global financial markets all this week. But the unexpected jump in capital expenditure in the third quarter made certain of it. The 12.3% increase was more than 4% above what the market had forecast, and another $10 billion was added to the total expected in this financial year. So despite all the turmoil overseas, Australian firms are not slackening off their investing in the future one bit. Of course, it's not all firms. In fact, it's really just one lot, mining. It's mining first, daylight second, and daylight third. Other economic data provided some balance to the good news on capital expenditure. Home prices are continuing to fall, down 0.5% in October and 4% for the year. And that's reflected in weak lending growth. Basically, the picture of the Australian economy is that the resources sector is flying, but consumers are battening down. They're not borrowing, not buying houses, and in general, preferring to save. The market interest rates on 3- and 10-year Australian bonds are now well below the cash rate, which means the market thinks the economy is going to weaken next year and the year after, and that there'll be a series of rate cuts now, including next month. The local share market had its third rise in a row thanks to gains in Europe and the US overnight. Once again, it was the banks that led the way with strong gains from ANZ and NAB, but only a small one from Commonwealth. And once again, the miners went backwards. The biggest rise among the leaders was Kohler, up more than 4%. November caps off a horrible 8 months on the market. The All Ords has declined every month except October, for a total decline of 15% since April Fool's Day. And that's finance.